Greetings. My name is Dave Yeski, and I'd like to spend just a few minutes sharing a few thoughts with you on the topic of how to build an all-weather portfolio. A portfolio that can weather all of the ups and downs, all of the economic storms that inevitably show up on the horizon. We believe there are fundamentally 5 building blocks to assembling an all-weather portfolio. They include the imperative to think globally. Consider the investment opportunities the world over and not stay focused simply in the US. Think low price. Consider the advantages of buying stocks that are trading at low prices relative to their earnings or their assets. Think small. Consider the advantages that have been offered by small company stocks over the long run. Focus on diversification. There is nothing you can do that will more powerfully reduce risk in your portfolio, and there are at least 4 dimensions along which you need to focus your diversification efforts. And finally, build resilience into the portfolio. Design it so that it can weather those inevitable downturns without doing harm to your long-run financial prospects. So think globally. While the US market is still the largest market in the world, it represents less than half the value of the world stock market. We believe that to get the best of all of the investment opportunities in the world, you need to consider the entire world stock market. And we also believe the best way to do that is to allocate your capital in a way that's proportional to each country and each region's share of the global stock market. And that's exactly what we do when assembling the stock portion of our portfolios. One of the things this does is it gives you diversification, because not every country is experiencing the same state of economic affairs at the same time. Some countries are surging while others are in recession. Exchange rate fluctuations will also add a degree of diversification. This is one of the things that is critically important when thinking about risk factors like low price stocks and small company stocks. You want to be able to select those across the largest possible universe of stock, and that means starting with the world stock market. Think low price. So low price stocks have certain advantages, but I have to first say what I mean by low price. Low price can refer to a stock's price relative to its earnings compared to other stocks or relative to its assets. Let's take a look at a concept called book value, which is a way of measuring the value of a company's assets. Book value encompasses the value of buildings and plants that are owned by a company. It encompasses the value of equipment and inventory, as well as retained earnings. So book value can become a very, very valuable benchmark when thinking about which stocks are high priced and which are low priced. Here's an example. Consider ABC Inc., which if you took its book value, the value of all of its assets, and you divided it by the number of shares outstanding, the number of shares that are out trading in the market, you'd find that it had $3 per share of book value. If you then observed the market price, how much are people buying and selling it for at this point, you'd see that it was trading for $6 a share. Well, if you divide the $3 book value per share into the $6 market price per share, you come up with a price to book ratio of 2. By contrast, consider another company, XYZ Inc., which owns the same $3 per share in assets, but is trading at $15 a share. When you divide that $3 into the market price of $15 a share, you come up with a price to book ratio of 5. So for every dollar of assets owned by XYZ Inc., you have to pay $5. Whereas for every dollar of assets owned by ABC Inc., you only have to pay $2. We would call ABC Inc. a value stock, and we'd call XYZ Inc. a growth stock. Now, your next question is undoubtedly, why should you care? Let me show you. If you had invested $1 into a basket of growth stocks back in 1927 and then watched it grow, assuming you had lived so long, you'd find that $1 invested in 1927 would have grown to nearly $2,000 today, which at first blush doesn't sound too bad. However, had you invested $1 in a basket of value stocks, as we defined them in the prior slide, today that $1 investment would be worth $7,000. So you can see that there's clear evidence for the superiority of buying low-priced stocks. And there's a degree to which that makes sense. I mean, when you buy something on sale, you expect to get more value for what you invest. When you buy, if you can buy your house cheaply, you might expect more appreciation. Well, the same thing applies to stocks. When you can buy them at low prices, you generally will earn a bigger return over the long run. Think small. Small company stocks also have behaved uniquely over the long run. If you had invested $1, also back in 1927, into the S&P 500, which is a very common, popular index of large blue chip stocks, you would have seen that $1 today had grown to $3,000. Again, at first blush, that sounds pretty good. Had you invested that same dollar, however, in a basket of small company stocks, in this case, stocks that represent the smallest fifth of the market, the bottom 20% by size, that $1 investment would have grown to nearly $21,000. Again, history shows us that the unique risks associated with owning small company stocks have tended to be rewarded with a unique increment of return. Now let's bring it all together. This illustrates the way in which Yeski Bui's portfolios are allocated with respect to the stocks. As you can see, we've broken it down along two dimensions, size and value. You can see that the small company stock allocations are illustrated in the front row, the mid-cap stocks or middle-sized stocks in the middle row, and the large company stocks across the back row. Likewise, growth stocks are represented by those bars in the right-hand row and value stocks on the left. Well, the first thing to notice is that when we build a stock portfolio, we're covering all the categories in terms of size and value. Yes, we own some growth stocks, but you'll notice that there's a significant skew to the left. We skew heavily towards value stocks. Likewise, although we own large company stocks, there's a significant skew in favor of small company stocks. And in this way, we diversify broadly across all categories, but we favor the small company stocks and we favor the value stocks. Now let's talk about diversification. So I mentioned that there were at least 4 important dimensions of diversification. The first is to diversify globally, to spread your bets, to spread your investments across all countries and regions. The second is to diversify across different types of investments, large company stocks and small company stocks, stocks and real estate securities, developed markets, emerging markets. Next, you need to be sure that you're broadly diversified within each of those categories. These are risky categories. When you invest in them, you get paid a return because you're taking risk. That's your compensation for taking the risk. So it's important to diversify within that category. If you're investing in small value stocks in the US, you can't just buy 5 stocks. You have to buy 500 or 1,000 in order to have sufficient diversification within that category. And finally, we believe currency diversification is important. When we're investing outside the US, we do not believe in hedging away the exchange rate risk. We believe in letting the foreign investments be denominated in whatever the local currencies are. As a consequence, less than half of our stock portfolios are denominated in dollar terms. Now, this is not a bet against the dollar. It merely means we don't want to be a prisoner to the dollar. We want to diversify our currency exposure as well as our country exposure as well as our stock exposure. Finally, we want to make it resilient. And the way we do this is by adding a stable reserve that's made up of cash and very short-term, very high-quality bonds. And the purpose of this stable reserve, especially for those who are spending from their portfolios, is to provide a bridge. Provide a bridge to support spending needs through the inevitable cyclical downturn in the stock market. The fact that stocks go down in value from time to time, it is not something that necessarily should be a cause for alarm. It's inevitable. Economic cycles wax and wane, and the stock market moves in sympathy with that. However, if during a downturn in the market you're forced to sell stock shares or mutual fund shares at depressed prices, you can eventually get into what I call a cascading failure, where you have to keep selling more and more shares at lower and lower prices in order to meet a fixed spending need. As a consequence of these cascading failures, you end up with too few shares left over when the market finally hits bottom to fully participate in the subsequent recovery. the way around this is to have a stable reserve that can bridge you through 5 to 7 years worth of spending needs, giving the stock part of your portfolio time to recover. So let's see how that has added up in historical terms. On this graph, we've illustrated in the tan color a benchmark that is made up, of two indexes. In this case, 70%, it's what we call a blended index. It's a blend of both stocks and bonds. 70% of this blended index is made up of the MSCI All Country World Index. This is a stock index that, as its name implies, covers the entire globe. And just as with our portfolios, it does so in a geographically neutral way. So it allocates itself to each country and region in a way that's proportional to that country and region's share of the world stock market. The remaining 30% of this portfolio is allocated to the Citigroup Global Government Bond Index, which again, as its name implies, is an index that encompasses global bonds of very high quality. What this is showing you, what this graph is showing you, is the cumulative return from 1994 until November 30 of 2013. Now, the cumulative return to this benchmark index was nearly 300%, or about 5% a year. The green area, meanwhile, represents the performance of the aggregate of all of the Yeski Bui client portfolios. So essentially, we lumped them all together and measured them as one big portfolio. And this represents the performance net of all fees and expenses along the way. As you can see, the portfolio did a little bit better than the benchmark, which we're gratified to point out. And the cumulative return over that same period from 1994 until the end of November of this year was over 400%, or nearly 8% a year on average. So how to explain the difference? We believe the difference can be explained in terms of our strategic decisions to dial up our exposure to small company stocks relative to the neutral index, and to dial up our exposure to value stocks relative to that neutral index, and that has explained the differential in performance. So just to review the 5 key building blocks of assembling an all-weather portfolio, they consist of the following imperatives. Think globally. Use all the investment opportunities the world has to offer. Think low price. Focus on stocks that are trading at low prices relative to their earnings or their assets. Think small. Focus on the advantages that small company stocks have offered investors over the long run. Diversify, and diversify across at least 4 dimensions. Geographically, across asset classes, within asset classes, and in terms of currency. And finally, build resilience into the portfolio. The amount of resilience is going to be a function of your life and circumstances, but consider what it would take to bridge you through a 5 to 7 year period during which there was a downturn in the market and during which you'd be giving your stocks an opportunity to recover. We hope you enjoyed our discussion of all-weather investing, and if you're interested in hearing more, we have more recordings and many articles that we've offered on our website, www.yebu.com.